Okay guys, so we have now got this question in front of us. The name of this question is Moyes Group. It says Moyes Group is a listed group of companies which have a year end of 30th September 2008. So that's what the year end is, 30th September 2008. The Moyes Group has changed its structure during the year and the directors are unsure if a disposal should be treated as a discontinued operation or not. The directors are unsure if the disposal is to be treated as a discontinued operation or not. They're also unsure whether another subsidiary should be classified as held for sale or not. So there are multiple things that have happened and they need your guidance on that. So the following exhibits available on the left hand side of the screen provide information relevant to the question. Now what exactly are the requirements to this question? The first one of them is draft an explanatory note to the directors of Moyes Company, which should include a calculation of cash generated from operations using indirect method. What is it that you have to use? Indirect method. And an explanation of the specific adjustment required to the group profit before tax to calculate the cash generated from the operation. So there are two things that you got to do. Now first of all, if I can actually go on to this specific thing, let's just try to see this. The computation of profit before tax. The computation of profit before tax. Now let's just try to see. We've got the financial statement extracts which are available. The following group: statement of profit or loss account for the year ended 30th September 8, revenue, cost of sale, GP, operating expenses, share of profit of associate, and then the profit before tax. Now what I am going to do is that, because my question's requirement is that I have to calculate the cash generated from operations. So what I'll do is that I would say the cash generated from operations. The cash generated from the operations needs to be calculated. What is it? The cash generated from the operation needs to be calculated. So it's a profit before tax. The profit before tax it has to be the adjusted figure, something like that. And then there are these adjustments for. So let's just try to see what exactly are these. So we have got profit before tax of 209. As per the question, it is 209. There is this share of profit of associate which is 67. Share of profit of associate needs to be removed from here. Why do we need to remove it? The reason being that it is shown in the investing activity. I repeat, because it is shown in the investing activities. Now what next is there? The extract from the group statement of financial position is given, the inventories, the receivables and the payables. I would just incorporate some working capital changes here. There's a decrease in inventory. There's a decrease in the inventory. There's an increase in the trade receivable. You would see my approach. What I am up to is that I'm just trying to put in the information as soon as possible into this specific scenario. Now what next is there? The next situation is there is this trade payables. And what is actually happening is there is an increase in the trade payables. There is an increase in trade payables. Okay, now what is the movement in the inventory? 126 minus 165. So if there is a decrease in inventory, that is an increase in the cash. If there is a decrease in inventory, there is an increase in the cash. The next thing is receivables is increasing. $149 minus 156. For the payable, it's a direct thing. Like if the payable is increasing, the cash is increasing. I'm not going into the logic of it. That is already understood to you people. I'm just incorporating the normal conceptual approach which we adopt for the cash flows. 215, 197. So 215 minus 197. So you've got profit before tax, there are these adjustments for there, working capital changes are there. Now what next is there? Notes to the financial statements. Notes to the financial statements. The following information is relevant to year ended 30th September 8. Moyes company operates a defined benefit scheme. A service cost component of 24 million has been included within operating expenses. The remeasurement component for the year is 3 million. If you do know, the remeasurement component is actually shown in the OCI, so it does not affect. This remeasurement component does not affect your P&L. Now, so what is it? It's the service component. The service cost of 24 million is included, so you need to add it back. Then benefits paid out of the scheme were 31 million. Benefits is being paid by a scheme, not by us. Contributions into the scheme were 15 million. So whatever the contributions that you pay, you show them as an outflow. Whatever the contributions that you pay, you show them as an outflow. So Moyes operates a defined benefit scheme. A service cost component of 24 million has been included in operating expenses. We removed it. The remeasurement component for the year was a gain of 3 million. So there was a gain of 3 million. So ignore it. Benefits paid out of the scheme was 31 million. Again ignore it because the benefits are paid by the scheme, not by us. Contributions into the scheme were 15 million. So we have deducted that. Goodwill was reviewed for impairment at the reporting date. Impairment arose of 10 million in the current year. So there is this goodwill impairment. It needs to be added back because it's a non-cash item. It's a non-cash item. Now, property, plant, equipment at 30th September included cash additions of 134 million. Which financial year are we talking about? 30th September 8. So this property, plant, equipment addition, this property, plant, equipment addition of 134 million is actually going to be shown in the investing activity. Is going to be shown in the investing activity. Now what next is there? Debit charge during the year was 99 million and impairment loss of 43 million was recognized. Let me just move it a bit forward. The depreciation charge is what? Depreciation charge is 99 million. Then what actually happens is that there is an impairment loss of 43 million. There's an impairment loss of 43 million. Prior to the impairment, the group had a balance on the revaluation reserve of 50 million, of it 20 million related to PPE in the current year. Of it 20 million related to the PPE in the current year. Now what actually happens is that there was a revaluation reserve of 50 million. What was there? 50 million, of it 20 million related to PPE. So that means of the impairment loss of 43 million, 20 million has to be recognized against revaluation reserve. The balance has to be recognized in the P&L. Should say equals to this minus 20. Yeah, Shilpa, do you get it now? Yeah, Shilpa, do you get it now? Okay. Now what happens is that the next one of them is about the inventory. So there are few adjustments with respect to the inventory that need to be done. Goods were purchased for dinar 80 million cash when the exchange rate was $1 is equivalent to dinar 5. Moyes had not managed to sell the goods at 30th September and the net realizable value was estimated to be dinar 60 million. And the net realizable value was estimated to be dinar 60 million at 30th September. Goods were purchased for dinar 80 million cash when the exchange rate was 1 dinar is to $5. Moyes had not managed to sell the goods at 30th September 2008 and the net realizable value was estimated to be dinar 60 million at 30th September. The exchange rate at this date was $1 is equivalent to 6 dinar. The inventory has been correctly valued at 30th September 8 with both the exchange difference and impairment correctly included within the cost of sale. So that means apparently there is no adjustment to the profit and loss account that you need to make. I repeat, apparently there is no adjustment to the profit and loss account that you need to make, because they have already incorporated every adjustment. Now what is the adjustment that has been done? Let's just try to understand. The inventory was purchased when the exchange rate was what? 5. $80 divided by 5 gives you how much? $16 million. Now, what has happened is that, and the net realizable value was estimated to be dinar 60 million at 30th September. So at 30th September, this was supposed to be 60 divided by 6 is equivalent to 10 million. What are we being told? The inventory has been correctly valued with both the exchange difference and the impairment correctly included within cost of sale. So now what happens is that this is a non-cash item. I repeat, this is a non-cash movement. Now if it is a non-cash movement, so what do you need to do? You need to say the exchange loss and inventory write down, which is 6 million, needs to be added up. What next is there? Okay, this is also done. Now, changes to group structure. It says during the year ended 30th September 8, Moyes acquired a 60% subsidiary and Devonport and also sold all of its equity interest in Barham for cash. Consideration for Devonport consisted of a share for share exchange together with some cash payable in 2 years. 80% of the equity shares of Barham had been acquired several years ago, but Moyes had decided to sell as the performance of Barham had been poor for a number of years. Consequently, Barham had a substantial overdraft, etc., etc. Now, that is something that does not have any impact on the cash flow. I'll talk about the discontinued operation, would see if there is anything pertaining to discontinued operation that needs to be shown. Apparently nothing. So if you could just look at it, am I missing out any adjustment to the profit before tax? Can any one of you suggest? Yeah, because I don't seem to find any adjustment to the group profit. Okay, there are no adjustments to the profit before tax, but you got to explain each one of the adjustment. That is what the examiner is asking you. So like for example, what is he saying? He's saying, okay, do it like this. Let me know why are you adjusting it. That is what the examiner is asking you to do. So the profit before tax is 209. You would say this is to be included in investing activities. Now what next is there? The service cost is a non-cash. Service cost is a non-cash expense and is added back. Non-cash expense, non-cash expense, non-cash expense again. Non-cash expense again. Decrease in inventory. Decrease in inventory. Now when I say decrease in inventory, what exactly do you mean by this? So the cash invested in inventory has been realized. Amount of sales not actually encashed. Purchases not paid for. The actual outflow from the business in respect of pension payments. So resultingly what happens is you will end up getting the cash flow from operating activities. You will end up getting the cash flow from operating activities. That is what it is going to be, the cash flow from operating activities. Okay, the 6 has already been incorporated in the inventory. This 6 has already been incorporated in the inventory, just look at it. The inventory has been correctly valued at 30th September with both the exchange difference and the impairment correctly included within cost of sale. It has been included already. Okay, so we are done with this specific part of the question, which was about the cash flow from operating activities. A lot of students, they get confused when it comes to cash flow, so make sure that you do practice 1 or 2 questions on the cash flows before you go on to the exam.